You've seen candlesticks in every trading chart, but do you really know what they're telling you? In this video, we're breaking down candlestick patterns in a way that's simple, visual, and actually useful for real trading decisions. Let's turn confusion into confidence. Candlestick patterns are one of the most powerful tools in a trader's toolkit. But figuring out the ones that will work is the most difficult part. After analyzing hundreds of real market charts, we've discovered 5 candlestick patterns that actually work, which will help you in earning bigger and consistent profits. In this video, we'll break down those high probability patterns, explain what they signal, and in bonus, we will share an effective candlestick strategy. These are all the topics that we are going to cover in this video. After explaining those 5 candlestick patterns that actually work, as a part of our bonus, we will reveal an advanced strategy which will help you out in making consistent profits. So now, let's not waste any time, and let's move ahead into the video. But before we dive into the patterns, let's quickly break down what a candlestick actually tells us. That's because once you understand this, the patterns will make a lot more sense. Every candlestick on a chart represents price movement over a specific period. This period could be 1 minute, 1 hour, 1 day, or even a week, depending on your chart settings. So, here, we have 2 candles on our screen. The red one is called the bearish candle, and the green one is called the bullish candle. This thick part is called the body. The body shows where the price opened and where it closed during a particular time. If the opening price is lower than the closing price, that means the price went up during that time, and a green candle will form. And similarly, if the closing price is lower than the opening price, the market moved down, and that creates a red candle. These thin lines below and above the body are called wicks. These shows the highest and the lowest prices that an asset reached during that time period. With just one candlestick, you can learn a lot about the market, like the open, high, close, and low. That's for key pieces of information in a single candle. And that's exactly why it's so important to watch how each candlestick forms. Because the shape, size, and even the wicks can reveal what buyers and sellers are doing in real time. Now, let us begin learning about candlestick patterns. The first candlestick pattern we are going to learn today is the engulfing candle. The engulfing candle is one of the most powerful candlestick patterns. It forms when the recent candle engulfs the body of the previous candle. This means that the previous candle's open and close are within the range of the current candle's open and close. This pattern indicates a shift in momentum from bearish to bullish. This example on the screen is of the bullish engulfing candle. And just like the bullish engulfing candle, there's bearish engulfing candle. The bearish engulfing candle forms when the price first makes a smaller green candle followed by a bigger red candle. The current candle's open and close is bigger than the previous candle. And therefore, we can say that this candle engulfed its previous candle. On its own, it's a solid signal for entering into a trade. Let's take a look at a real chart example to see how an engulfing candle works. The price forms a bullish engulfing candle at this area. This signals a strong bullish momentum, which simply means buyers are stepping in aggressively. That makes it a potentially high probability entry point for a long trade. Enter at the close of the bullish engulfing candle and place your stop loss at the low of this candle's wick. The price moved up as expected and helped us earn significant profits. Now, let's look at an example of the bearish engulfing candlestick pattern. The price forms a green candle with a larger body compared to the previous candles, along with smaller wicks. Following this, a bearish engulfing candle appears, indicating that sellers have taken control of the market. Entering a short position from this area would be a wise decision. The market moved down, giving us significant profits. Now, let's move on to the next candlestick pattern, the Doji candle. The Doji candle is a candle with a small body and bigger wicks at each of the sides. There are 3 types of Doji candles. The first one is the classic Doji. It's a candlestick with a very small body in the center and long wicks on both sides. This pattern indicates indecision in the market, where neither buyers nor sellers are in full control. The second type is the dragonfly doji. It has little to no upper wick, a small body positioned at the top of the candle, and a long lower wick. This formation tells a story. Sellers pushed the price down significantly, but strong buying pressure brought it back up by the close. It signals potential bullish momentum. The same concept applies to the bearish dragonfly doji, but in the opposite direction. The next one is the gravestone doji. This candle has a small or nearly invisible body at the bottom, with a long upper wick and little to no lower wick. The bearish gravestone doji indicates that buyers attempted to push the price higher during the session, but by the end, sellers stepped in and dragged it all the way back down. This candlestick suggests that sellers still have control of the market. This candle usually forms at the end of an existing trend. Now, let's see how this type of doji candle can be helpful to us on real-time charts. On this chart, we can see the market forming a gravestone doji candle. This indicates that buyers tried hard to push the price above the opening price, but due to strong bearish momentum, they couldn't succeed. Therefore, the market closed below its opening price. Now, we need to wait for a strong bearish candle to form, which will provide confirmation. Since the price has formed a bearish candle, let's go short from this point. Place your stop loss at the upper wick of this doji candle and set your target based on your preferred risk to reward ratio. The price moved lower, giving us significant returns. Now, let's move on to the next candlestick pattern, which is 3 inside up and 3 inside down. We'll begin by learning about the 3 inside up candlestick pattern. In this pattern, a bearish candle forms first, indicating that sellers are dominating the market. Then, a small bullish candle forms, with a body smaller than that of the previous bearish candle. Finally, a third candle forms, whose body closes above the opening price of the initial bearish candle. This pattern indicates that momentum has shifted from bearish to bullish. Because of this, the pattern is known as a reversal pattern. Let's look at an example of this on a real chart. In this chart, the market is making lower highs and lower lows, indicating a downtrend. We then observe a large bearish candle, followed by a small bearish candle, but this does not yet confirm a 3 inside up pattern. The second candle in this pattern can be either bullish or bearish. In this case, it is a bearish candle. The pattern is complete when the third candle forms a strong bullish candle that closes above the open of the first candle. That's our confirmation. The price then forms a bullish candle with a large body that closes above the open of the previous candle. At this point, we can enter a long position from the close of this bullish candle. Place your stop loss at the low of the initial bearish candle and set your target according to your preferred risk to reward ratio. As we can see, the price continues to move upward, hitting our target and delivering strong profits. Now, let's move on to the second pattern, the 3 inside down candlestick pattern. This is a bearish reversal pattern and is the exact opposite of the 3 inside up. In this pattern, the first candle is a strong bullish candle, indicating that buyers are in control. Next, a small bearish candle forms. It remains within the body of the previous bullish candle, indicating hesitation in the upward movement. Finally, the third candle is a bearish candle that closes below the open of the first bullish candle. This signals a shift in momentum from bullish to bearish, and that's why this is considered a reversal pattern. Let's look at a real chart example. In this chart, the price is making higher highs and higher lows, indicating an uptrend. Then, we see a large bullish candle, followed by a small-bodied bearish candle that stays within the range of the previous candle. We then see a bearish candle forming, which closes below this bullish candle's open. Now, we can consider this pattern as 3 inside down. Let's go short from this candle's close. Place your stop loss at the high of this bullish candle and set your targets as per your preferred risk to reward ratio. The price went down, giving us out significant profits. Now, let's move on to the next candlestick pattern, the rising 3 and falling 3 formations. Let us first learn the rising 3 pattern. In this pattern, the price first forms a large bullish candle with a strong body showing buyer strength. Then, we see some small bearish candles, indicating some short-term selling or a pullback. But importantly, these candles stay within the range of the first bullish candle. Finally, a big bullish candle forms that closes above the high of the first candle, clearly signaling that the buyers are back in control. This is a trend continuation pattern, not a reversal. It tells us the uptrend is likely to resume. Now, let's look at a real chart. Here, the price is making higher highs and higher lows, which confirms we are in an uptrend. We can witness a strong bullish candle, followed by some small candles that stay within its range, showing a pause. Then comes the breakout candle, a large bullish candle that pushes through the previous high. That's our signal to go long. Stop loss goes below the first candle's open. Set your target as per your preferred risk to reward ratio. As we can see, the market moves higher, giving us a profitable continuation trade. Now, let's move on to the opposite pattern, the falling 3 candlestick formation. This is also a trend continuation pattern, but it signals that a downtrend is likely to continue after a small pause. In this pattern, the price first forms a large bearish candle showing strong selling pressure. Then, we see few small bullish as well as bearish candles, suggesting a temporary pullback. But here's the key. All of these smaller candles stay within the range of the first bearish candle. Finally, a strong bearish candle forms that closes below the low of the first candle, confirming that sellers are back in control. This tells us that the market is resuming the downtrend after a small consolidation period. Let's see this on a real chart. Here, we can see the price making lower highs and lower lows, a clear downtrend. We then see a large bearish candle, followed by some small bullish as well as bearish candles. Then, the next candle is a strong bearish candle that breaks below the range and closes lower, confirming the pattern. We will go short from this point. Place your stop loss at the low of this bearish candle and set your targets as per the risk to reward ratio you want. As expected, the price continues going downward, which gave us a profitable trade in the direction of the trend. This pattern is perfect for traders who look out for trading the continuation trades. Now that we have learnt about the top 5 candlestick patterns, let us move on to the strategy. But before we do so, here's something really important to understand. Candlestick patterns become way more powerful when used with key levels. Let me explain it in a proper way. You might spot a morning star or an engulfing candle anywhere on the chart, but not all of them mean the same thing. What makes a pattern truly meaningful is where it appears. When a candlestick pattern forms right at a key level like a strong support and resistance level, trend line, or supply and demand zone, it's no longer just a pattern. It becomes a high probability setup. Let's say we see a bullish engulfing candle. If it appears in the middle of nowhere, it might simply be profit booking or the entry of few buyers. But if it forms right at a major support level where price has previously bounced, it becomes a potential signal that buyers are stepping in again. So, don't just trade patterns in isolation. Instead, combine them with support and resistance zones, trend lines, or Fibonacci levels for stronger confirmation and better results. Now, let's move on to the strategy. In this strategy, we'll use the confluence of major key levels and candlestick patterns. Let's learn this strategy through an example. So, here we have higher highs and higher lows, which indicates of an uptrend. The price has made a support zone at this point. We can see that the price is coming back at this level. There are doji candles forming at this point. After that, price forms a bullish engulfing candle that engulfs its previous candle. This is the sign of buyers stepping in aggressively. Let's go long from this point. Set your stop loss below the support zone and place your target as per the risk to reward ratio you want. The price continued moving upwards, resulting in significant profits from our trade. Now, let's see an example of the confluence of trend lines with candlestick patterns. So, here we have the price making higher highs and higher lows, which means we're in an uptrend. We can see price respecting this trend line as it went above twice after reaching at this area. Again, the price has reached at this level. The price is making doji candles at this level, which signals that neither buyers nor sellers are dominant. Let's wait for the price to make a bullish confirmation in order to enter into a trade. The price finally makes a bullish candle with a bigger body, which gives us a confirmation. We will go long from this point. The stop loss will be placed a little below this trend line, and the targets as per the risk to reward ratio you want. We usually keep 2.5 or 3:1 risk to reward ratio, but it's upon your trading style and your risk management. The price continued going upwards, giving out significant profits. This brings us to the end of this video. So, in this video, we learnt the best candlesticks confluence strategy that will help you out in making consistent profits.